Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
But what I really look for, it's not really the doji itself. It's not the doji itself that really gets me to liquidate longs or maybe reverse and go short. It's the change in the momentum. And the momentum change that I'm looking for is if you see the market close below, and that's where we see this close right there, close below the low of the doji. So that's what I think is very important for traders to look at. If you notice that if this is the low of the doji and this is the close of the next bar, then that's the signal, that's the setup that I truly look for. And when you're looking at foreign currencies such as the EUU with the Euro currency index with the ISE, you'll see a lot of these intraday patterns, and this is very important to pay attention to, especially on a, let's say if you're using a shorter-term time frame chart, like a 15-minute. When we look for these after long rallies, these are the types of turn signals that I like to look for to help me time entries into the market on market reversals. Now, a simple rule, folks, is this. If I'm not using an options strategy, which you should probably want to do, but if you want to know when to enter into a position, then when you wait for the actual close of the bar. And when you do that, your entry would be on that close or the very next session's open. So if the next session opens and trades all the way lower even further, 2 bars later, you're going to get short somewhere in that vicinity. Your stops could be resting on a trade back above the high of the doji. So the entry is on the close of the next session's open. Your stops are placed above the high of the doji. So the doji really does have a very prominent feature in not only setting up specific trades, but they give us also the trigger in which to act, not based on the doji itself, but on the next bar. That's what's critical. So looking at dojis when they never exist before, especially after long uptrends, are important tells or reads or hints that the market is at a turning point. There's indecision in the marketplace. And it's not that I act on a doji because they could simply be in by itself. That doesn't mean that the market's going to reverse. Just having a doji could mean it's a potential pause before the storm of a further price advance. You need to wait for confirmation of that next candle, and it's that close relationship below the low of the doji. That's what we call the low close doji that I've written about in several of my books, and that's why we've labeled it LCD. When the market closes below the low of the doji, that's the trigger to sell short. The opposite is true with the morning doji star. The problem is we never really see a lot of morning doji star patterns. But what we do see is after downtrends, we see a lot of doji patterns. And so that tells me if there were, after a long descent or decline in values in marketplace prices, then when we see a doji, it indicates that that's perhaps a pause in the market. So for me as a trader, I look for those signs or those clues, those hints that the market's probably going to cease, at least pause, its descent. It's the next candle making a higher close. And let's take a look at what we see in this from what we've just discussed, utilizing simple candlestick construction. This third candle, let's take a look at it. We see that it is a white or hollow real body candle, which signifies what? That the close is above the open. We also see that we formed a higher high and a higher low. So that's not bearish. That's actually showing us that the market's now perhaps reversed the bearish conditions. But more importantly, the close is closer to the high of the current bar. But the most important element is that the market closed above the high of the doji. This close is above the high of the doji. And so therefore, that's the most important element in looking at what we call the high HCD, high close doji pattern. If you can remember that, it's a real simple pattern because that's what I would see, and that's why I labeled it, because I'd be staring at charts and staring at markets all day, and man, I'd be looking for that high probability morning doji star, which never showed up. But one thing I did notice is that I saw a lot of doji patterns, and the common thread or common denominator in looking at dojis that then we saw market reversals is that the one common denominator is that the market closed above the doji high. And that's where I came to the conclusion, and that's why I published the work of a high closed doji pattern is so relevant in one of my bread and butter type setups on a daily basis, is that especially if they come near an important pivot support level, I have a nice little setup. I have a defined trigger against a established support zone. I look to buy on the close. My stops go beneath the low of the doji, and I want to see immediate results. And there's a couple little nuances with trading this. The high close doji has to happen within so many bars. It can't be like 2 weeks from now. It's got to be almost immediate, within 3 bars. And in addition to that, I put my stop initially. That does not mean forever. I put my stop or my risk factor if I'm buying call options expecting a market to advance. Then if the market comes back and fails and closes back beneath the low of the doji, I'm not going to sit around and wait for the market to come back and hope and pray. I'm going to try to get out of the trade as best as possible, because that means perhaps the market did fail and it's going to head even lower. Why should I stick around and give the market my money? I can always look for another trade and get back in the game. So the key is obviously risk management. And in looking for high probable setups, I like to look for trades and I like to look for patterns that have had a high frequency of reoccurring with a high frequency of success. And both looking at the low closed doji and the high closed doji, which are derivatives of the evening and morning doji star formations, have done just that for me. Because if you're an avid trader and you've studied candlesticks, you probably will agree. It is very far and few between where we see the textbook morning and evening doji stars. But if you look at these two patterns, the bearish implications that an evening doji star has and the bullish implications that a morning doji star has, the common denominator is that the market on an evening doji star, the third candle closes below the low of the doji. In the morning doji star, the third candle closes above the high of the doji. And that's the sequence of events that gives us our setup and our trigger to enter in the long side. What you decide and what product and how you decide to trade, that's a different animal. And that's where using options is so helpful, because perhaps you're looking at a timing element. If we're looking for a reversal to occur, we should see immediate results, not results 6 months from now, immediate results. So maybe if I'm looking as a swing trader or a counter trend trader, maybe I want to look at credit call spreads. If the market's looking like we're going to see, after a long increase in price, we're going to see a reversal, maybe I'll do a credit call spread and take in some premium. If we're going to expect to see any positive results, it should show up, and the key word here is immediate. Within at least 1 to 2 bars, we should see some follow-through. Then I know I'm right in the trade.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.